You are listening to KeyStone Stock Talk Show, episode 266.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Great to chat with you again. We have a busy show planned ahead of our new launching of our small cap 10x stock investment live webinars next week. I will kick off this week with a Your Stock Our Take on Parex Resources Inc., symbol PXT, on the TSX, an oil-weighted producer in Colombia with a solid balance sheet and a dividend yield of just under 9%. A listener asks us if we can explain why the shares are off 30% this year, despite what looks like a solid last quarter and good valuations. Many of you will be happy to hear that Mr. Aaron Dunn is away on assignment again. I'm kidding. Never fear, he has sent his segment in remotely, and he will be looking at investing in dividend and dividend growth stocks in the context of the current interest rate environment and the likelihood of declining rates. Brennan answers a follow-up question from his segment last week. The viewer asks if the following three stocks, Visibility Group Technologies, VSBY on the CSE, HPQ Silicon Inc., HPQ on the TSX Venture, and Victory Square Technologies, VST on the CSE, all offer 10x potential, or if any of them offer 10x potential. Brennan will get into that. And last but not least, Brett answers a viewer question on the concept of guidance or management's guidance on their annual or quarterly results of a company upcoming and how you should use this information. All right, let's get to the show. Again, my co-host, Mr. Aaron Dunn, is on assignment. He will have a segment remotely for us today, and we can comment on that. The Killer Bees are here, Brett and Brennan, and they're going to rescue the show again this week. How are you guys doing?
Doing well.
Doing good.
Good. Excited for we got webinars coming next week. These are all new webinars, kind of how to find the next 10x stock. Three of them, really. There's one next Tuesday. That is the 27th at 7 p.m. Pacific. Then there is the following Thursday, I believe, the 5th of September. That is at 7 Eastern time, 7 p.m. Eastern time. And then we have a special webinar, which package you get an entire VIP membership, and that is on September 21st. I think that's a weekend. It's a 5-hour webinar. We won't go into detail a ton on that today, but if you go to www.keystocks.com, click on the picture of myself and Aaron there, which is painful to click on, I'm sure, and let me punch on it. And then you can get to both options, the 2 to 3 hour 10x seminars, and then the full portfolio building seminar as well. But we'll go through the agenda for that 10x seminar in a second. Let's answer our poll question, or look at that poll question. Brett, you got to look at our poll question, and then we'll get to it. It kind of dovetails into the seminars as well.
Yeah, so as many of our viewers know, we like to focus on small cap companies, and a trade of them is they have low liquidity, we're volume traded. And really what we want to ask you is, do you view quality low liquidity stocks like the ones we cover much of the time as a net positive or opportunity? And 48% of you guys answered that. 18% of you guys answered neutral, or it's a balance of risk and opportunity. And 34% answered a net negative or an overall risk. Which is, I would say we're as always, we're skewed a bit towards the small cap investor. So it's not surprising we came with a bias towards a positive. But I think generally when you're looking at a small cap, a lot of people do actually see it as negative because they think, I can't get out of my position or I'm going to have troubles getting in. But that can be really a benefit towards a smaller investor. Most likely you are a small investor unless Warren Buffett happens to be listening to our podcast, as he should, of course.
Of course.
But
Yeah.
but unless you're managing, expecting to put $1 million plus in a position, even if you're doing 100,000, most of the time that's not what these large companies are really worried about at one that size. Even for a illiquid stock, you can normally enter an exit position within a day or two with a $100,000, $200,000 position, which is larger than what most people will be putting in when it's a 5% position in your portfolio. So it generally can actually be a positive for an individual retail investor. Normally liquidity concerns are there when you're a large institutional investor, unless you're running a massive fund, and then obviously things change a bit at that point.
Yeah, it's both a risk and an opportunity, I would say. You got to, make sure that it's not too illiquid. There are absolute extremes in both ends. But yeah, I mean, it's definitely an opportunity to find a mispriced company. I mean, Warren Buffett is famously quoted that he, if he just had $1 million that he could put between, say, 10, 20 stocks in that range, it would probably be 10 for him. He's very concentrated. But he thinks he could do 50% annually, and he can't play in that sandbox, which is these smaller companies. He has billions to invest that can start to move the needle in his portfolio. And that's where he is envious, and is the only area that the small investor, the average investor, basically has an advantage over Buffett. Is, even if you have $1 million or a couple million, you have a significant advantage over him because you can play in this segment where you can find more mispriced securities. And to give you an idea, we're talking in this seminar about 10x stocks. Some of the stocks that have produced 10x gains, like if you look back at Hammond Power, was significantly, would be considered a relatively illiquid stock when we originally recommended it. Now you can move in and out of it relatively easily, but it was an opportunity. Boyd is the same thing. Now you can move it out relatively easily, but it was illiquid. Expel, relatively illiquid, but opportunities because they are less followed. And we talk about that in the upcoming webinar, why these companies are opportunities and why they do outperform over time.
Yeah, like I definitely think like it's a net positive. But again, like when you're dealing with these small caps or, just low liquidity, patience, just you need to have or exercise patience. The amount of times that I have seen, someone not use a limit order or just use a market order, and all of a sudden, they're buying shares, 5, 10, 15% higher than they could be if they just kind of, place a limit order and, kind of let the market pick away at it.
Yeah, you can buy a company over a week, a month. Like
Exactly.
You don't have to buy it all in one swoop. Like you don't have to buy it all in one day, 1 hour. Doesn't have to happen that way.
Yeah, and it can save you money. Like even, there's another example where all of a sudden, a stock is trading at, 50 cents and someone wants to bail, 50,000 shares or whatever in this low liquidity, and they move the market themselves right down to 30 cents, and they're, basically, cutting their position in half, basically, or selling, at such a discount when, again, I understand they want to exit the position, but, if you do utilize some patience, there will eventually, I mean, it depends on the story, obviously, or the financials of the company, but eventually, someone will be picking away at your own shares if you place a limit order there.
Yeah. And again, not all small caps are created equal. We are looking only at profitable small caps. You say 50 cents, but we're looking for good solid earnings behind that 50-cent stock or that $2 stock or that $5 stock. So we just have to stress that every time. There's low liquidity crap stocks. There's low liquidity stocks that have good solid fundamentals behind them that can be an opportunity. You have to find the ones with the good fundamentals.
Yeah, and you can really benefit over time because once those institutional investors are able to invest in it, liquidity will start to turn off, and it's kind of that cascading effect. Is once one or two institutions start to get in, creates liquidity, allows more institutions to get in, which allows the price to go up because you're not pricing in that illiquidity premium, which many of them will.
Yeah.
So it really it's a great run-on effect.
I think we've seen that in probably at least 5 companies from our coverage over the course of this year, where now they become significantly more liquid. And you've seen institutions finally identify those companies as good investments that they want to put their clients in, they want to invest in either through their own fund or their individual clients. And you've then seen the initial investment thesis that we've had on these companies confirmed, and they've gone significantly higher because you have that institutional buying. I'd rather buy before the institutions are buying, and then you get that lift up in the multiple too as well, and you get the better liquidity that you want. But you've got to be there early, and you've got to find a company before the regular financial or the broader financial arena is looking at it. All right, well, let's quickly go through an agenda. I'm going to try to make this as quick as possible. Full agenda. Section 1, we're going to look at where to find the next 10x stock. So we're going to show you the formula that we use to identify some of the 10 to even 100x stocks. The Hammond Power is up 20,000%. Boyd up 9,000, up 10,000% now. Jana, Waterford, Expel, all these companies that have done well over 2,500% gains. How did we get to those? How 2 to 3 stocks in your lifetime in your portfolio can change your portfolio. Why do we look at small cap stocks? So why are we invested in this area? So some proof there. 87% of all global equities that went up 1,000%. So did actual 10x returns over the past 10 years, began as small to micro cap stocks. Why do we look at profitable small cap stocks? 82% of those stocks that went up 1,000% did the 10x. At this, when they started their ascent, they were profitable. 91% of those, so more than 9 out of 10 had some history of profitability. That's why we look at small and profitable. Section 3 is going to look at the generational opportunity right now. Small caps trade at their lowest levels relative to large caps in 25 years. We're going to show you on some measurements, they look more expensive. If you look at the profitable small caps, and we'll look at the large cap or the small cap S&P 600, the valuation relative to the large caps are continue to be attractive, despite the fact that we've seen a significant uptick in those over the past year. We're going to look at Section 4, how to construct a full portfolio to benefit from game-changing 10x stocks. The hardest part is finding those companies. In many cases, you might think your job is done there, but in that section, we'll show you if you have them in your portfolio, how you can benefit from them. If you own 150 stocks, one of those that goes up 10x is probably not going to benefit you. We're going to show you the optimal number to hold within a portfolio. Learn how to hold great 10x stocks, best behaviors or best practice in financial or behavioral finance. So you're going to look at, yes, it's again, you've got that 10x stock that is growing in your portfolio. How do you learn to hold that company over the long term? So some of the psychological warfare that you face in your portfolio or in your own head, we're going to dwell on that. We're going to go over that and teach you best practices in behavioral finance. That's Section 5. Section 6, the profile of a great small cap stock. Looking back at where we've been successful in the past, where we can continue to use that profile to identify the next potential 10x stock. We're going to look at an intro. We are launching a new U.S. small cap research service. We're going to introduce that within this webinar and show you what we plan to cover, the portfolios within it that we're building. And as a bonus, all attendees will receive one recommendation from that service. Receive a starter small cap portfolio, 5 to 6 profitable small cap stocks that you can buy today. And finally, Section 9, a live hosted Q&A session at the end, about 15 to 25 minutes. We'll answer any and all your questions on the webinar itself, but also on North American small and micro cap stocks. So that gives you a good overview of the upcoming webinar. We look forward to seeing you there. August 27th, 7 p.m. Pacific, September 5th, 7 p.m. Eastern time. And there's the 21st if you want that full VIP portfolio package. That is 11 a.m. Pacific time on the September 21st. All right. Should we move on? Get to the show. I've got a question to answer in my Your Stock Our Take segment. Yep. Okay, today I'm going to look at Parex Resources Inc., symbol PXT on the TSX, trades around $17.50, $1.76 billion market cap, has a juicy just under 9% dividend yield. Parex is headquartered in Calgary, Canada. Operating office is in Bogota, Colombia. It's the largest independent oil and gas company in the country. That's Colombia. Parex is an oil-weighted producer focused on conventional high productivity reservoirs in Colombia. Now, let's look quickly here. There's a number of positives for higher risk energy investors, including the fact companies always maintain a relatively strong and unlevered balance sheet in a very volatile end industry. The company has also had a track record here, as we see, of returning capital to shareholders, continuing to pay and raise the dividend and buy back shares, reducing the share count and increasing cash flow on a per share basis. Let's take a quick at the company's long-term capital allocation framework here. Now, the plan is to reinvest about 2/3 of FFO, or funds from operations, into the business, and then return slightly greater than 1/3 to shareholders. This will drive, it's really driving their sustainable business model, investing in long-term growth and replenishing development inventory. They also have really just started the progress on their Big E. They call it their Big E investments. That's big swings designed to hit high impact reserves. This is essentially in Colombia, and the potential to produce outsized returns for the business. The buybacks here that we've seen, they target dividend growth over time, ensure sustainability through the commodity cycle. So they're ensuring the payout ratio is relatively low, but they can grow that over time and is sustainable dividend through commodity cycles. Again, those share repurchases are continuing to reduce the share count and juicing the EPS, or the FFO, per share over time. Now, let's look at the 3-year growth plan. They're growing production and funds, what they call free funds flow, from 2024 to 2026. The plan is based on an average of $70 Brent crude oil. 5% annual production growth is what they're targeting from their operating blocks. Spending around $375 to $450 million of capital per year. $50 million is invested of that in high impact exploration annually towards those Big E investments. Targeting $850 million in FFF, that is free funds flow, over the outlook period, so over those 3 years. Now, my comments on this would be the 5% production growth is solid given the natural declines of some of its older operations. As you can see, the LLA 34, which oil companies are really always fighting against. But I do think for the market to really get excited about the business, they would have to hit on a couple or one of their Big E targets. This is why we see the $50 million set aside annually for high impact exploration. Now let's look at the Q2 highlights here of the business. 2024 production shown here as oil and gas, or BOE per day, or barrels of oil equivalent per day, was down slightly year over year and sequentially. Better energy pricing helped improve netbacks, or margins, for the business. You can see there. We would prefer to see growing production. We do expect that to uptick in the second half of the year. FFO was up smartly sequentially, and lower CapEx increased free funds flow significantly sequentially. Let's look at product outlook for 2024 and their guidance. Parex's fiscal year 2024 average production guidance was 54,000 to 60,000 barrels of oil equivalent per day. Capital expenditures guidance of between $390 to $430 million, trending towards the lower end of their respective ranges. Lower production primarily reflects underperformance at one of its wells where it is drilling. Previously disclosed temporary shut-ins in the northern Llanos, while lower capital reflects reduced spending on the Aruca and LLA 38, with some offset from the increased spending in LLA 32 and LLA 122 and Capachos. I'm sure I've blown the pronunciation on those, but you can read it on the screen, hopefully, and you understand what I'm saying. The balance sheet here, we'll take a quick look at it. It is very strong and should move to net cash throughout the year. $55 million in net debt, which is only 0.1 times net debt to EBITDA ratio, which is quite low, particularly for an oil and gas exploration and development company with production. Valuation summary: EV to revenue over the trailing 12 months is around 1. The EV to adjusted EBITDA fiscal year 2024 expected is 1.8, which is quite low. EV to cash flow per share is around, for this year, is just over 2. So the valuations and dividend the valuations, dividend, and return of capital appears to be attractive, yet the share price, as we can see here, is down 30% in 2024. Well, the declines, we would say, are primarily in relation to the forecasted production growth that has not moved forward as fast as originally expected. As a result, results have been lighter than expected, and growth is being discounted to a minimal rate. The near-term pessimism is likely overdone, but either a larger drill bit success from one of its big drills or programs, or a steadier sequential increase from a number of new wells is likely needed as a catalyst. Parex's Q3 production was below the consensus. The company's commentary that 2024 production results are trending towards the low end of guidance has hurt the stock. Q2 cash flow was ahead of consensus and but the beat on the Q2 cash flow was realized basically from an FX gain in the quarter. So we'd like to see it more from production gains. Parex is a potential option for investors looking for exposure to oil and gas, but we just released a buy on another new energy or oil and gas company with roughly 40% of its market cap in cash and likely a higher growth profile, at least in the mid-term. So that's my conclusion on Parex.
So Parex is, I like the structure of the company just because it has such strength in the balance sheet. Where in oil and gas, obviously, you're dealing with some times where you're going to be unprofitable, and yet you still likely would want to make CapEx. Because during those times, sometimes it can be the best time to make CapEx because the same things that other oil and gas companies are looking at, they can't afford. If you can, that can be great opportunities for expansion in the long term. Where if you don't have any cash, you're already in debt, you can't do that, and then you're further strained by the interest expense at the time. So it's always great to see a cash-rich oil and gas company, where Parex is right at the line right now. They're net, 0.1 net debt to EBITDA. Yeah. So effectively, they're neutral, and they've previously been net cash, which is something which I would expect them to be in the near term. They may already be during this quarter once this quarter ends. It would not be surprising. So that's something which I would really look at as when you're seeing really this negative momentum in the stock. If it does keep going down, let's say it stays the same, if they do start to build up a cash position, it kind of puts a lower bound onto where it can drop. So then you have that massive margin of safety. If you have a cash-rich company, it's been really beaten down by the market because they weren't able to hit their growth. If they're able to then return to growth, in Parex's case, let's say their big E expansion, it plays out properly. It's executed well on. This is the bull case scenario, I should say. And then they're building the cash and the market's still punishing them during that time. That can be just absolutely lucrative in oil and gas, and it has lower downside risk because they're building up cash, which is just great.
Yeah. And I mean, you got that very strong dividend. I mean, dividends in energy producers, we consider almost a bonus, even though in this case, they've been very responsible with it over time. And they owe, many of the companies in the Western Canadian Sedimentary Basin that pay a dividend also have significant debt. So you're really, your cash flows can be squeezed in a down or negative market. Well, in this case, this company is typically operated with a net cash position. So if there was a quarter where they were really squeezed, or a period of time when they're really squeezed, they could still maintain that dividend. You don't want them maintaining it just out of cash, but it is there if you have the cash flow or cash on the balance sheet too. It's not there if you're in debt. And that's the way. I mean, it is a capital intensive business. We get that many of them have to borrow to continue to grow the business over time, because you're always having to replenish those reserves. But if you can do it with a cash with balance sheet, at least it gives you that margin of safety. If you're going to pay a dividend, hopefully that balance sheet is strong, because that it is a volatile segment. And again, this company, if you look back 20 years, they have outperformed like most Western Canadian just exploration and production companies. So, a good name, and it is trailed back to what is a significant low, it looks like, on the company. So, it's not a significant recommendation here today, but we can see the reason why somebody would be attracted to a company like Parex, particularly if they can go to growth again. If you can see growth again, then you've got some growth, you've got a good dividend, you got a good balance sheet. So that's, those things. And if you're trading at reasonable valuations, those are things that check off some of the boxes we're looking at. It's always going to be volatile with the price of oil. If oil has a great year, it does better. If it doesn't do as well. That's, we're always going to say that.
Yeah. Now, I will just add, on top of the dividend, which is already high, they are repurchasing significant amount of shares. It's not one of those companies which is that they repurchase 0.01% of their shares and they're calling repurchase. They're purchasing a percent a quarter right now.
Yeah.
Which is just massive.
It is, for sure. Okay. Well, we're going to move on to Brennan's segment. It's kind of a follow-on, a viewer question on the segment you did last week, where somebody was looking at, 30 bagger, 30 times stock. Now they're saying, are these possible 10x stocks? Now you're just going to talk about some of the basic elements that we look at when we are looking for, we're not looking for it. We're not out there just searching, this is the next 10x stock all the time, but some of the elements from the stocks that we have had in the past that have gone up that much. And you can see a stock that we own today with the potential to do that. What are the basic criteria for that?
Yeah, exactly. So yeah, we got this question on YouTube following my segment on Trigon Metals, as we were exploring the possibility of it having the potential to be a 30x stock or a 30 bagger, because some listener thought that it potentially was and wanted us to look at it. So this question comes in from Mark Pelon, who said, hi guys, awesome opinions. He must have been just talking about myself rather than these guys. Just kidding. Talking about possible 10x, what's your opinion on Victory Square Tech, VST, HPQ Silicon, and Visibility Tech, or VSBY? Hope you're interested in enough for your opinion. Thanks. So just quickly looking at these stocks here, Visibility Group Technologies, VSBY on the CSE, currently trading about 7 cents and $2.3 million market cap. So they operate as a software provider for retail analytics, technology solutions for real-time analytics and audience measurement, as well as offering hardware units, including displays and other related advertising services. From my understanding, it's primarily in like brick and mortar businesses, as well as they do have like some smart city applications, from my understanding. HPQ Silicon Inc., or HPQ on the TSXV, currently trading at a price of about 35 cents per share and about $129 million market cap. So they're a technology company specializing in the green engineering of silica and silicon-based materials, and its products are sought after by end users, including manufacturers of lithium-ion batteries, electric vehicles, as well as anodes for lithium-ion batteries, among others. In the last year, Victory Square Technologies, or VST, on the Canadian Securities Exchange, trading at about 11 cents and the market cap of 7.6 million. And these guys are a private equity and venture capital firm specializing in incubation, acquisition, and invests in startups, early stage, and provides the senior leadership and resources needed for growth. Through its portfolio companies, it focuses on technologies in blockchain. Could be a lot of buzzwords here. Blockchain, digital health, Web3, creator economy, metaverse, machine learning, climate tech, youth, mental health, healthcare, special needs, technology, First Nation, AI, et cetera, et cetera, et cetera, et cetera, et cetera. So here are the stock charts of each of these three stocks. So VSBY is in the green color and is down 98% over the past 3 years. HPQ Silicon is in the red or slightly burgundy color and is down about 53% over the past 3 years. And Victory Square is in the purple and is down about 79% over the past 3 years. So all in all, all of these stocks have performed quite poorly. And this right here is the reason why. Well, VSBY, it has limited revenue and no profitability or cash flow. We can also see HPQ Silicon, no revenue. And of course, with no revenue, no profitability or cash flow. And Victory Square. It does have revenue and at least some recent momentum in growth in revenue. But again, no profitability or cash flow. So to me, it's not overly a surprise that these companies' stock prices haven't performed quite well over the past 3 years. And to conclude, realistically, just given the lack of profitability, none of these companies have the profile, or at least what we would say, the profile of a business as a potential 10 bagger. Now, before a listener rebuttals my segment here with a comment like, well, if you don't buy a stock before it becomes profitable, you miss out on the run. That just isn't true to us. We are mitigating the risk, the extreme downside risk. Like VSBY is down at 97%. There's a reason being. It's not a business yet. Like the data is clear to us. Ryan already said this, but to cite the Global Outperformers report done by Jenga Investment Partners, 87% of all global equities that went up 1,000% or more over the past 10 years began as small to micro caps, which these companies are all small to micro caps. However, 82% of those were profitable at the start of their ascent, and 91% had some history of profitability, which none of these companies have at this point in time. Now, by investing in a business after it has already broken into profitability, you're mitigating your risk significantly, as the business model has been validated as a cash generating entity, which at the end of the day is the primary goal of business. You don't want to, start a business to lose money and sell this story. You want to eventually generate cash flow. So again, Ryan also mentioned this. We will be doing our webinars on August 27th and September 5th, where we will highlight potential 10 bagger stocks. So if you, or I guess the profile as well, for potential 10 bagger stocks. So if you want our exact profile of these businesses, make sure to sign up for that webinar, and we'll go more into detail there. But number one, we are looking for profitable businesses.
Yeah, and I think you hit on it there, that the ideology that if you wait till it's profitable, you're missing out on the the blue sky returns. Just the data, and don't just go for our opinion. Look at the data, and the data was there plainly in front of the screen. If you're looking for a 10x, 1,000% return, the companies that actually produced 100% or 1,000% returns were the companies that had some level of profitability. 91% of them, so over 9 out of 10 of the companies that produced those 10x gains over the past decade in the stock market, actual companies that did this, had profitability. And you're just playing you're stacking the odds against you if you go to the 1 out of 10 that wasn't profitable. Why not go to the 9 out of 10 area? That's where we're playing in that field, because that's what the data tells you to be in, and that's where we find those companies. So you can argue the fact, but you're arguing against data, and that's not usually a smart strategy.
Yeah, and one of these stocks may miraculously go up, significantly, but how do you have visibility? Again, we always get, oh, the technology, this, that. Well, one thing that drives share price returns, it's growing earnings per share or growing cash flow per share. That is what drives share price returns. And if you see a trend or maybe an inflection point in a business, then yes, maybe it does have 10x potential. But to say oh well, this market is a huge market and it's untapped. Meanwhile, the company has no revenue, no profitability, continuing to burn cash flow, issuing shares to continue to keep the lights on. Again, there's no visibility there. How can one confidently say that this stock could potentially, or with some confidence say that this will be a 10x stock? It's much, much more difficult to say.
And one thing which I will add is those were all really great stocks during that 2021 run up. If you didn't notice, when investors weren't looking at profitability, they were looking at the story, really, not even revenue growth in many cases. They were just looking at the story, and these are story stocks.
Yeah.
And then once over time you have things needing to return to fundamentals, the stock price deteriorates massively, and that's what Brennan's seeing in that 3-year stock price where you're down 80-90%. And this is the time and time again with companies that did see that 2020 and 2021 run up in their stock price, that didn't have anything really fundamental financials underlying their story, is they fell apart over the last few years. And likely, unless the funny money stage comes back, or if we're not even looking at 3 years ago, we're looking at 2000 in tech, you're not going to see those same profiles of stocks run up. Yes, there are periods in time, and people will point, oh, this stock during this period of time when everything went up substantially, if I bought at the bottom and sold at the top and I was a perfect timer, I would have made 15x. But you are not going to do that consistently, if ever. And if you're doing this year over year, time and time again, you're losing 9% of your money every 3 years. So when you do hit that 10, 20x stock, you're playing with 5% of your initial capital.
Yeah.
It just doesn't play out over time.
It makes no sense to use that type of strategy. And, you know, again, we presented the data, but also, you know, anecdotally, you look at the 5 companies that I just talked about. Were they small caps at the start? Were they profitable? Well, you know, Hammond Power, small cap, profitable, undervalued, growing. Boyd, small cap, profitable, undervalued, growing. Jana, small cap, profitable, undervalued. I mean, I can go on. Waterfront, same thing. Expel, same thing. So there's 5 real world examples. You know, if you want to find a stock like this, look at that profile. Do not look at a company that maybe is trading at 5 cents or 10 cents, but it just has no underlying profit and has a story. It's not a good area to be in. It's just the data says that. We, over 25 years, have looked at the markets, the stocks that produce the best returns, profitable, growing, and smaller companies that are undervalued. And that's really, it's more complicated than that, but I'm simplifying it down to like 3 or 4 elements right there. That's what we would look at to find your next 10x stock. And we'll talk about that in our upcoming live webinars. We look forward to seeing many of you there. All right, let's move on to our final segment, right? Or do we have Aaron's segment first, or should we do?
Oh, let's do Aaron's segment first, probably.
We should do Aaron's segment, right? Yes, before Brett, because Aaron just loves to go before Brett for some reason. So let's get him in there. And Aaron is going to talk about, what is he talking about? That income dividend stocks, right?
Yep.
And in this current environment, in the where rates they are today, and if there is a decline in rates and how they can fare over time.
Okay, so my segment today is going to be on investing in dividend growth stocks, and I'm actually going to do this in the context of the current interest rate and fixed income environment right now. We obviously saw a very sharp increase in rates, bond and GIC yields over the last year and a half, and just recently those rates have started to come down. So how do dividend stocks and dividend growth stocks fit into your portfolio in the current environment? So just to give a little recap on what dividend growth investing is and why it's attractive generally, dividends are essentially, it's a way of generating income from your stock portfolio. So dividends provide cash flow to investors. Now, this can be used as income for investors that need that income, but it can also be reinvested in the stock market or in other investments. A sustainable dividend growth, so for dividend growth stocks, this can help drive the stock price returns over time. And the best and the most well-managed companies generally do pay dividends. So there are groups of investors out there who don't need dividends, aren't necessarily attracted to income in their portfolio, but you wouldn't want to dismiss dividend paying stocks just because they pay a dividend. If you're to do that, you're essentially ignoring some of the best companies out there. And finally, what I'm going to get into later on is that dividend growth stocks on average actually substantially outperform non-dividend payers, and they do this with a lower level of risk. But let's take a look at dividend stocks versus fixed income stocks and what the differences are. Because right now, particularly in the higher interest rate environment, a lot of people that were attracted to dividend paying stocks in the past have really been reconsidering fixed income and adding more fixed income to their portfolios. So the most important thing, or one of the most important things to understand with the dividend, is that a dividend payment is at the discretion of the company. So dividends are typically paid on a quarterly or monthly basis, and the board of directors of that company is going to decide and at every payment frequency whether or not to pay a dividend. So they can increase the dividend, they can reduce the dividend, they can also eliminate the dividend solely at their discretion. Now, fixed income, which would be bonds or GICs, they work differently. The interest payments are a legal obligation of the bond issuer. So if you purchase a bond, whether from the government or even from a corporation or a GIC from a bank, you have a legal entitlement to those interest payments on the frequencies essentially that you originally agreed to when you purchased the bond, that are part of the bond's covenants. Now, if you're investing in a corporate bond, there's always the possibility of a default of the company, but only in the case of a default or bankruptcy can they avoid making those interest payments. It is a legal obligation. Now, on the flip side, dividends do have the opportunity to grow. So dividend growth stocks, these are companies that, because they're growing businesses, they have the ability to increase their dividend payments on a consistent basis, usually on an annual basis. And what this does is this produces a compounding effect on the income return. So if you invest $1 in a stock today and that company is increasing its dividend per share on an annual basis, then your yield on that investment in today's dollars increases over time. Whereas with fixed income investments, these interest payments are fixed. So they are an obligation. They're more guaranteed, but they're also fixed. So the interest payments don't increase over time. And that means that whatever your income yield is really just going to reflect the current interest rates of the day. Now, when you purchase a bond or any type of fixed income investment, there's going to be a maturity date. So for example, you might purchase a 1-year GIC or a 5-year GIC. That means when that maturity date comes due, you're going to be repaid that money that you invested in the bond. And you're no longer going to receive any interest payments. So at that point in time, you're going to want to have to reinvest that money if you want to continue to generate interest income on it. Now, if you're reinvesting that money, you're basically just going to get the interest rate, the current interest rate. And that may be a higher rate than your original, the interest rate on your original investment. It could be the same or it could be lower. You just don't know. It's impossible to predict where rates are going to be in the future. But this is a chart of the GIC rates for the 1-year GIC going back to 2019. And we can see here, 2021 up to 2022 where rates started to increase. Rates were almost zero. So at that point in time, for most investors, there was really no reason to consider fixed income or GICs. You just weren't generating any type of return. But then from 2022 upwards to 2024, the current year, rates suddenly started moving upwards. And they hit a peak in 2023 of about 5.1%. So about a year ago, they hit this peak of 5.1%. Since then, they've come down somewhat. We've seen the Bank of Canada reduce its interest rate twice now in the US. The Fed is expected to start reducing their rates after couple of years of increases. So bond yields have already reacted to this, and we've already seen bond yields, GICs, come down. Right now, the current rate on average on a 1-year GIC is about 3.9%. So the way this would work is, say a year ago, you had money to invest and you decided you would put it into a GIC. You could buy a 1-year GIC and you would have made 5.1% interest rate on that 1-year GIC. So that's pretty good. Certainly if you're comparing that to many dividend stocks, and I know I had this discussion with investors a lot, they would say, well, why should I take on greater risk by putting my money in a dividend stock when I can get an fairly equal income yield by just putting my money in a GIC, which is guaranteed. So I'm going to explain, or illustrate how this is not an apples to apples comparison. And that really comes down to that compounding effect of dividend growth. But say you were to purchase that GIC a year ago, you got your 5.1%, you're very happy. Now the year has come due, the maturity date has come due, you've received that money back from your GIC. Now you have to figure out what to do with it. Now, if you want to put that back into a GIC, your return now on that money is going to be 3.9%. So you're going to actually see a reduction in your income yield. Now, if you're if you're an investor who really relies on that cash flow, fixed income, the risk really involved here is that you don't know what the interest rate is going to be in the future. So, you might be happy with that 5.1%, 3.9% might be okay. But when you renew that GIC a year from now, it could be 2%, it could be 1.5%. You may be getting almost no income yield on it at all. So this is one of the risks of investing in fixed income. Now, a GIC is risk-free from the perspective that there's essentially no default risk, because if you're buying it from a reputable bank, it's insured. So there's no issue with getting your money back or your interest payments. But the risk is that you don't know what rates are going to be when the maturity date becomes due and you need to reinvest that money. Now, let's compare this to a dividend stock. And I'm just going to use an example of a long-term investment that we made at KeyStone, long-standing recommendation going back all the way to 2021. This is Brookfield Infrastructure. The symbol is BIP.UN. So Brookfield is what we would consider to be an income growth stock. When we originally recommended the company back in 2021, it was paying annualized distributions of 53 cents US, and it's essentially increased its distribution every year over that period of time. So just turning out cash flow, growing the business, growing the cash flow per share, and increasing that income distribution every year. So that income distribution is essentially almost tripled from 2011. So every year, you're essentially getting a higher dividend or distribution on your investment than you did the year before. Now, what does this look like in terms of extrapolating it going forward? Well, the current yield on the company right now is 5.2%. Now, they're generally targeting distribution increases in the range of about 6% per year, sometimes a little higher, sometimes a little bit lower. Now, if you were to take that dollar that you're investing today, or whatever you're investing today, your income yield on that today is going to be 5.2%. But assuming that they continue to increase their distributions at an annual rate of about 6% per year, if we extrapolate this going forward 5 years, then your income yield now on that dollar invested today is actually close to 7%. It's about 6.9%. And if we were to extrapolate this out again, another 5 years, so 10 years in total, your income yield on that dollar of investment today is 9.2%. So this is what I mean by the compounding effect of growing distributions and growing dividends. You're actually generating a higher stream of cash flow on every dollar invested today, whereas with GICs, fixed income, they can't replicate this. And this is why it's really comparing a dividend growth stock with a fixed income investment it's really an apples to oranges comparison. Fixed income, as the name implies, is fixed until the maturity date when you don't know what your income yield is going to be. For a dividend growth stock, as long as you invest in a company that is a strong fundamental business and continues to be able to grow its cash flow per share and its dividend per share, then you're going to get an ever increasing stream of dividend income. And this is one of the reasons why we think that dividend growth stocks are very attractive investments. Now, just to look at Brookfield Infrastructure, just to give you a little more information on how this looks, like what this cash flow profile looks like. If we were to take based on our original recommendation price in 2021, which was about 950 Canadian per share, this company has paid out total distributions over this period of time of almost $14 US. So well in excess of our original recommendation price, just paid out in cash flow. Plus, you still have a company that's paying an attractive yield. You still have a company that has that's continuing to grow and produce share price appreciation. Now, the accumulated distribution growth over this period of time is 189%. And the yield on that original purchase price, so every dollar that was originally invested in the company back in 2011, based on today's distribution, is about 22%. So this really exemplifies the profile, really the ideal profile of what we would consider to be a dividend growth stock. And this sets dividend growth stocks well apart from fixed income. Now, if we look at the historic performance of dividend growth stocks, we can see that actually these strong fundamentals or the strong cash flow profile really shows up in terms of performance. So there's data calculated every year from RBC Capital Markets comparing dividend payers and dividend growth stocks with the rest of the market going back to 1986. So if we look at dividend growers over this period of time, they produce an annualized return of 10.8%. Now compare this to the average for the TSX, 6.2%. Certainly strong outperformance there, but then compare that to non-dividend payers, so companies that don't pay dividends, only a paltry 1.1%. So massive outperformance for dividend growers, but also better performance in terms of risk. So same time period, but this measures annualized volatility. So annualized volatility essentially is just a measure of how widely a stock price fluctuates. We can see dividend growers on the left, annualized volatility since 1986 on average of 13.3%, less than the overall market, and then again, significantly less than non-dividend stocks. So higher returns and lower risk, and that is really the recipe for investment success. Our belief is that dividend growth stocks really should form the foundation of an investor's portfolio. This doesn't mean that you can't have fixed income. It certainly does not mean that you shouldn't have more growth-oriented stocks that don't pay dividends in your portfolio. But really, dividend growers form the base, the foundation, and then from there you can augment that return by adding layers of risk, such as more exciting themes in technology, growth-oriented stocks like small caps, profitable small caps. But we really believe that systemically you would set yourself up at a disadvantage if you don't make dividend growth investing an important part of your portfolio. Now, just in terms of the current environment, as I had mentioned before, rates are starting to come down. We don't know where that's going to trend, how low they're going to go. But as rates went up, what essentially happened is that a lot of investors psychologically became less interested in dividend paying stocks. So we saw valuations compress. A lot of the sectors that are associated with lower growth, more consistent dividends, but lower growth, which might be utilities, REITs, a few other segments of the market, they've not performed well over the last couple of years due to that rising interest rate environment. Now we're seeing that reverse. We're seeing interest rates start to come down. And if this continues, then we would expect to see more investor interest and more investor capital flow back into some of these dividend sectors. So we do believe that there is a good opportunity right now over the next couple of years to purchase good, solid dividend companies, many dividend growth stocks for attractive valuations, and set yourself up with a good stream of growing income in the future, as well as some capital appreciation as well. So we have our research right now. We're in the process of putting together a Canadian REIT report, which covers all 40 Canadian REITs in Canada, and making our top picks. And then we're also looking at utilities and other areas in the dividend space as well, just in the context of the lower interest rates. But really, as a long-term solution, we think that dividend growth stocks have to be a part of every investor's portfolio. Right. Thank you.
Yeah, so that's always a great point, Aaron, especially when we're not directly around you. It's even better. But the great thing about income stocks versus dividend or versus fixed income really is that growth. But also, a lot of people don't pay attention to the risks of fixed income as well, which Aaron did mention it. when you are, it's called rollover risk, is when it matures. You have to reinvest into that next fixed income instrument. And even if you're not doing it directly, if you're buying, let's say, which many people do, a bond ETF of the likes, is you're still facing that rollover risk, but it just goes over time. And that is something which a lot of people do, is they'll just pick up a bond ETF and they think, oh, I'm not facing that rollover risk when something matures, because the ETF itself doesn't mature, but the underlying bonds or whatever fixed income instrument you're using, normally will be bonds, do mature. So you're constantly facing this rollover risk. So you are always realizing at the same time that those lower and lower interest rates, versus a dividend growth stock, normally it will slowly go up. And of course, you do need to see for a dividend growth stock for it to be supported by underlying cash flow and net income, likely both. And if you don't have that, it won't become a dividend grower, because obviously your hindsight, it's, a dividend grower once you've looked at it over time, but you need to also look at it ahead of time. And when you do have some stocks that will pay a massive dividend, they had a one-off great quarter, great gain, they'll issue and say, oh, we're going to start issuing a dividend. Then you'll see a year or two down the line, they have to cut the dividend completely or neuter it quite a bit, because they didn't have that supporting cash flow, versus, let's say, something which is just great and has that cash flow. And that's really what we're wanting to see, is cash flows support the dividend growth, and that builds over time, and they're able to reinvest. And that's really the key to dividend growth stock versus fixed income. You're not going to ever have that.
Yeah, and I'm not sure if Aaron touched on the power of the compounding that dividend over time. If you have it if you're growing that dividend over time, we have some effective yields like Hammond Power. If you bought it just 4.5 years ago in the 6-7% dividend range, it's now 8. You're getting paid every year 18% if you bought it at that $7 range. Tremendous. Dynacor was, when we originally recommended it, didn't even pay a dividend. Now you're getting, on that $1.80 to $2 originally purchase price, it's gone up to 5+, but you're getting around an 8% yield on that, and it's growing every year as well. So that really, can really produce good returns over the year, and allows you to stay in that stock even as it trends sideways and then goes on a next leg up over time. So dividend growth stocks, a great way for to have a core part of your portfolio and growth over time. And they there could be some of those names, if rates continue to come down, that you could get suddenly everybody, oh, I'm in love with dividend stocks again. And you should always be there with the dividend growth names, but then you get a more premium versus a discounted multiple on some of those names.
Dividends or go on, Brett, sorry.
Oh, I was just going to say, normally you'll see them dividend growth stocks, that being, will move kind of along with interest rates as they fluctuate. It's how the stock market works. It's all interconnected. I'm not going to dive too far into that. But when we are in now likely a rate cutting cycle, at least for Canada, likely the US at this time, it's almost a certainty, is you'll start to see investors who were in fixed income, they're at 5-6% fixed income rates right now. If once it starts to go down to 4-3-2%, they might migrate to these dividend growth stocks, which will drive the price up. You get that capital gain as well, and yet you're still getting your effective yield.
Yeah, and all I was going to say is just, I think that dividends are so underrated. I mean, I know that a lot of investors prioritize them in their portfolio, but especially for like younger investors, when I was in university, I wrote them off. I was looking for, the 10x potential stock in the wrong place to look for the 10x potential stock, but it's because
the diamond in the rough.
Exactly, the diamond in the rough, you could say.
Literally, yeah.
literally. But that's the thing. There's nothing that I love more than looking at my account and seeing my cash balance grow, knowing the date that the dividend hits. Again, I'm boring, but it's quite exhilarating to me.
We're not going to argue with you, Brennan. We're not going to argue. Yeah. So we're going to finalize this show, put a bow on it with Brett's segment on how to look at guidance, what is guidance when management issues guidance, and what to do with that information.
Yeah, so we got this, we've got a question, or various degrees of this question. It's really, what is management guidance? How are you meant to interpret it? And really, what is the information they provide and how you're meant to deal with it? In that sort of sense, we've had a few over the last couple of months. So Simply put, management guidance is what just management expects to occur financially or operationally in a future period, whether it be the next quarter, the next year. Depending on the company, it may be referred to outlook or similar terms to that, but I'll just be using the term guidance to keep it a bit more simple. It is a non-standardized thing and can vary greatly depending on the company, the industry. Some industries, they'll use similar guidance figures, but then other times they won't be even remotely close to each other. The more common common guidance figures that will be used are things like revenue, gross profit, EBITDA, but even those can vary between companies since they might use adjusted figures or not standardized. They might take in things, they might have had an acquisition which they want to adjust for. So things like that you need to be considering. You always want to look at the footnotes when you are looking at guidance, as well as some other common metrics are various margins, so EBITDA margin, gross profit margin, and so on, as well as their operational metrics, such as for an oil and gas company, the amount of oil produced. They'll do probably barrels of oils per day or barrels of oil equivalent per day, things like that. As well, management may provide what I would call supporting metrics, such as the price of oil, which they expect, but they can't really dictate these metrics, which allows you to account for market expectations. So if your expectation for oil prices is lower or higher than management, you can adjust their figures and then go from there. Also, management is likely to provide guidance as a range, as even with higher company knowledge, it is practically impossible, if not impossible, to predict a financial metric down to a pinpoint ahead of the finalized results. As well, you may hear the terms miss or beat guidance. These terms really just mean a miss is below the guided expected range or above the guided expected range. And that's really that term you'll see again and again. And that may be applied to as well at analyst consensus. But then if you see miss the guidance range, normally that would be referring to the management's guidance itself. So looking at an example for Meta, or Facebook is what most people will still be calling it, since they rebranded a couple years ago now, in their Q2 press release, they have the CFO outlook commentary or guidance. They expect revenue of 38.5 to 41 billion, so a low and a high range. There we are. So we or other management say that they would be on the low end of this range, for example, would be closer to 38.5 billion, or if on the high end, if we were saying they're on the high end of guidance, they'd be closer to that 41 billion. And you would commonly see that we expect to be on the high or low end of guidance range. And especially when management's looking a year ahead, they'll start to give commentary where they expect to be in their range, or they'll narrow or expand the range if needed. As well, they note a 2% foreign exchange headwind due to exchange rate changes. In other words, something that will impact their revenue, but they really have no control over. So for an exchange rate drastically changed, you would expect revenue guidance to change as well. And you can adjust your own figures for that. While for Meta, this will likely only shift financials slightly as they're dealing in more mature currencies. Companies which have more volatile currency exposure could have significant changes, and that can dramatically change, especially when you're looking at developing countries. If they're operationally dealing with a very developing country's currency, it can be 20, 30% over the course of a year, and it's very hard to pinpoint those currencies. So you want to take in consideration management's assumptions of foreign currencies as well as other things. With guidance as well, companies may provide qualitative commentary, which we can see here with the statement, we expect infrastructure costs to be a significant driver of expenses over the next year. The color management provides can be just as important, if not even more important than the number, as it starts to feed in what expectations they have and how you can build your own assumptions and your own models on top of that. And it will provide additional details and as well as context for what guidance, even in this case, because they say that they are not providing quantitative or numbers, you can start to build in what they're expecting even further ahead in time when you're looking at the qualitative. So don't just look at the numbers. So shifting to another company in a completely different industry, ConocoPhillips, which is an oil and gas company, they provide their production expectations, their depreciation and amortizations, their corporate net segment loss, adjusted operating costs, and capital expenditures. These are all cost figures, except for with the exception of the production figures, as they have more control over those than, let's say, even their revenue due to oil prices. They provide other metrics such as the return on capital, the expected tax rate. As well, they do provide a sensitivity analysis to oil prices, and that's how you would really build out what you want their net income, assuming your assumptions. And once you fill that in, it gets a bit more complicated. Once you're at that point, you need to do a full model, but that's what you would have to do in an oil and gas company, because that is, you need to deal with the sensitivities to oil, or this is true for any other commodity-driven company, so gold, copper, anything like that. So, but as you can see, metrics will be used and that they'll guide on will vary significantly depending on the nature of the business and even what the management wants to disclose. And some companies may present the data to include actual results or expected results as well, and they build out throughout the quarters. As you can see in ConocoPhillips, here they give the Q1 actuals, the Q2 actuals, as this is the Q2 guidance, and then their full year guidance. And some will break it out a bit more. And normally you'll see that denoted by A and E in their guidance. So A means actual, E means expectations. So if you do see that, just know the difference between the two. Expectations is what they expect to come. Actual is what's already occurred. Because we'll occasionally have people say, oh, they did this when the results aren't out for 6 more months. So how would you use management guidance or outlook? You'll see analysts, whether it's us or ones on Wall Street, use guidance within our models to value a company, as management has, or at least should have, a better picture of the company's performance ahead of time than we can, as they have intricate knowledge and insider information. So what we do is we can use their guidance as a baseline for a model and then build in our own assumptions and change and tweak their own assumptions. Like I was saying, if we expected oil to be higher than what they did, we can put up their revenue and so on. As well, the market is forward-looking and uses guidance for the valuation. If a company has a significant shift in guidance, whether up or down, that can have a larger impact on the market reaction or the stock price than the reported earnings, which are normally released at the same time. You'll see guidance released in a press release normally, or the presentation for a quarter. And then sometimes you'll see the headlines, the stock goes up 10, 20% because they had such great guidance, or reversely, they go down because they had such poor guidance. And for example, we've been seeing this over the past year in NVIDIA. Every analyst has been effectively laser focused on their guidance more than anything else. And that's what you'll see lead the headlines, is NVIDIA has popped up way ahead because they have had such strong guidance again and again. And that's something which you will see time and time again, is the market will actually rely more on the guidance than the actual results, especially for high growth companies. Additionally, guidance can really be used to help track management performance. If there are deviations from guidance, it may be due to lack of execution or even at times knowledge of the company or industry. You'll see that occasionally, where their guidance just seems like they're just rolling dice to come up with guidance, which obviously that doesn't reflect great on management. So some other considerations. Guidance it's only provided, like I said, in the press release, earnings call, MD&A, presentations, or in multiple spots. Sometimes management will refer to it, or they won't refer to it, and they'll just have it at the bottom of their slide deck, and it really just depends. And as well, what you need to consider is management guidance may not always be reliable. We see this time and time again in commodity-based industries, where they'll guide to specific revenue, but be way off due to a shift in the underlying commodity. And even then, some management is just poor at guiding in general, normally being overly optimistic, if anything, and making guidance they generally do not provide. It's not really something you can end up relying on if they do keep getting it wrong time and time again. So if you are looking at guidance, you should look at how competent management really is. Look at their past record of guidance. Look at the prior guidance for the last few years, compare it to the actual results. Were they in the same ballpark? If they did deviate, why did they deviate? Was it just because of market conditions? Was it something that out of their control, interest rates, commodity prices, and so on? So that is something you need to do, is check their actual track record. Some companies, they will release targets as well, which are in the same vein as guidance, but they're more aspirational and generally on a longer time scale and generally less specific. So while targets can be used in a similar fashion to guidance, you need to really make the distinction in the weight management puts on the precision and the timeline of their targets compared to guidance. And sometimes they'll use the word target in place of guidance, but most of the time target will refer to something 3-5 years over a long period over a long-term plan. And I really want to emphasize that management has really no obligation to continue guiding metrics and can potentially stop at any time. normally you'll see this after a significant miss in metric, and they no longer believe they can predict their own results with any sort of conviction. So you'll see they no longer have guidance, and normally the market will have a negative reaction to that. So that is something that can occur. As well, they can change what metrics they guide to, and they may narrow or expand or shift guided ranges as their expectations change. And like I said before, guidance is non-standardized, and lots of times they will use non-standardized or adjusted metrics because things are unique to a company, and lots of management teams, they want to make them somewhat comparable to the broad company. So if they do have an M&A, they want to adjust their figures for that, because otherwise, most time M&As, when they initially occur, they'll have heightened costs, and you don't really see the benefit of it right away. So they want to adjust those figures so it's not, oh, we did absolutely awful, when it was really they just executed an M&A, and it could actually be a positive for the company. As well, I will mention a criticism of guidance is it can cause the market as well as management to hyper focus on the select results and create short-termism for the company and it's really at the detriment of long-term results. As well, that can have management sandbagging or guiding lower, so they look like they beat the guidance over and over again, when in reality they expected to be beating it, which is just poor guidance at that point. It's not really guiding the market, it's just saying, oh, we want to look good. And then the second that can't happen anymore, the stock traders, once they're unable to do that. So to summarize, guidance can be a great tool to help you value a company or anticipate performance, but you should still be skeptical and consider if management's assumptions are aligned with your own.
Good. That's a really good summary of guidance for
Yeah,
sure,
great
and
job,
how you can use it, within, when you're looking at an individual stock investment. One of the things that I would key on there is definitely the track record of management in their guidance, and how well you can take seriously essentially what their guidance is going forward. And we often will look at a management team, a company that we're either following, that we want to recommend, or a company in coverage, and you'll rate them higher if they continue to either hit or exceed guidance over time. And then the opposite is also true. If they continually, repeatedly miss guidance, I mean, that's not a company that you want to be involved with over the long term. So yeah, it's the track record of management on guidance in terms of making an investment in a company is important.
Yeah,
the successful track record.
And I would add as well is you need to be critical if they're constantly being above what they guided, because then they can be just sandbagging results. And you do see that.
You just got to definitely factor that in. Like if they're always going 10% above, they're sandbagging. The market catches on to that, right? Over time, and then you're going to the market's going to say their guidance is at 10 cents per share. Well, you're going to get 11 or 12, so they're just going to factor that in. And if you don't hit the 11 or 12, even if you hit the 10, you're probably going to be hit. The stock gets hit. So it's kind of the optimal is probably they hit 10, and once in a while they hit 12, that. So they're on the guidance, and once in a while they exceed. What you don't want is continually, underperforming the guidance. And I mean, there are reasons in a quarter. Missing guidance in a quarter is not, like, people tend to overreact sometimes. If it happens once or twice out of 8 quarters, there is one-time items that it can hit a quarter, and that are unforeseen, and it is perfectly reasonable for a company at times to miss their guidance. If it becomes a pattern, then it's not a problem. It is a problem. All right. I think we'll end off that segment. I think that ends off our podcast for this week. Again, we encourage you and look forward to seeing many of you in our live webinar next week on the 27th. There's also one on the 5th, the 10X stock webinar, and then the full portfolio, VIP portfolio, you can get on the 21st of September. So look forward to seeing you next week. Keep your questions coming into our Your Stock, Our Take segment. We'll continue to answer those like we answered Parex this week. And if you are viewing this right now on YouTube, smash that subscribe button, or if you're consuming this wherever you consume your podcast, rate and review us. We'd love to see those positive reviews. Thank you very much, and I wish you profitable investing.
Thanks, everyone.
Thank you.